Hello, everyone. So, you're thinking of moving abroad, maybe starting an international business, or perhaps you're an investor looking at Canada from the outside. Fantastic. But before you do anything, we need to talk, because your relationship with Canadian tax authorities, it doesn't just stop at the border. Today, we're going to untangle this very complex web of Canadian international tax. Okay, here's our game plan. First, we'll figure out what your tax residency actually is. Then, we'll get into the pros and cons of that. After that, we'll tackle investing. We're talking everything from real estate to crypto. Then we'll move on to the rules for your international business. And finally, we'll take a peek into the future of global taxation. All right, let's get right into it. This first part is the foundation for everything else, so it's absolutely critical. Once you physically left Canada, are you actually gone? Or are you still very much on the Canada Revenue Agency's radar? You might think that once you've packed your bags and the plane has taken off, you're off the hook. But, well, the Canada Revenue Agency, the CRA, has a very different point of view. The truth is, severing your tax residency with Canada is incredibly difficult. And, frankly, that's by design. The government is trying to protect its tax base, and that means they make it hard to leave. So how did they decide? Well, the CRA uses what's called a factual resident test. And it's not a simple checklist. It's a deep dive into what they call your center of life. They're looking at everything, your most significant ties, all your secondary connections, what your real intentions were when you left, and yes, they also look at the number of days you spend in the country. Now, these are the big ones, the absolute deal breakers. If you check even one of these boxes, you have a home in Canada that's sitting empty waiting for you, or your spouse or kids are still here, the CRA will almost certainly say you're still a factual resident. And what does that mean? It means you are taxed in Canada on your entire worldwide income, money you earn in Dubai, Singapore, anywhere. But it doesn't stop there. Oh no. Even if you clear those major hurdles, the CRA then puts on its detective hat and starts looking at a whole laundry list of secondary connections. We're talking about things that seem small: a car in storage, an active Canadian bank account, your driver's license, even a gym membership. Each one of these is like another thread tying you back to Canada. Your goal has to be severing as many of these threads as possible. If all this uncertainty is making you nervous, there is a way to get a clear answer. You can file a form called the NR-73, which is basically you asking the CRA to make an official ruling on your status. But, and this is a huge but, you really don't want to do this alone. It can take over a year, and you should absolutely do it with a lawyer to make sure your information is protected by solicitor-client privilege. You don't want to accidentally give the CRA the ammunition they need to rule against you. So after hearing how hard it is to actually cut ties, you might be asking a pretty logical question. Are there any good reasons to stay a Canadian tax resident, even if you're living somewhere else? And this, right here, this is the core conflict for so many expats. On the one hand, you get to keep access to Canada's world-class healthcare, that amazing social safety net, and your Canada pension plan follows you wherever you go. But the price for that security is steep. You're looking at some of the highest personal tax rates in the world, often tipping over 50%. Plus, other benefits, like old age security, can actually get clawed back if you're out of the country for too long. It's a serious trade-off. Okay, let's switch gears and talk about investing. Specifically, we're going to look at how Canada's tax system treats two completely different kinds of assets that are super popular with international investors: good old-fashioned real estate and the new Wild West of cryptocurrency. Now, if you're thinking of buying property in Canada from abroad, you need to be really strategic. First off, there are foreign investor taxes to worry about. But the real hidden trap here is a concept called permanent establishment. This is a huge deal. It means that just by owning that one property, you could accidentally pull your entire foreign corporation into the Canadian tax net. And on top of all that, your tenants are legally required to act as your tax collector, withholding 25% of the rent and sending it straight to the CRA. All right, let's talk about crypto. For anyone dealing with crypto in Canada, the single most important thing to understand is how the government sees it. The CRA does not think of Bitcoin as money, like a dollar, and it doesn't see it as a security, like a stock. For all tax purposes, crypto is treated as a commodity, just like gold, oil, or even sugar, and that one decision changes everything. Here's why that commodity label is a bombshell. If the CRA decides you are actively trading crypto with the goal of making a profit, then your gains are considered business income. That means they are 100% taxable. You do not get the 50% capital gains break. So imagine your crypto goes from $1 to $60,000. That entire profit, all of it, could be taxed just like your salary.
Ouch.
But in tax law, there's always a fascinating exception, isn't there? There was this one incredible case where a lawyer took Bitcoin as a payment for his services, then basically forgot he had it. It doubled in value. He argued in court that he had absolutely no intent to trade it. It was just an oversight. The government fought him on it, and they lost. The court siding with him, and he got to treat it as a capital gain. This is a huge deal because it proves that intent is the magic word. But proving you didn't have intent, well, that's a very, very high bar to clear. All right. For all the entrepreneurs and business owners out there, this next section is for you. Let's talk about how Canada can reach out and tax a foreign company, even if it's registered halfway across the world. This brings us to a concept I find fascinating, the heart and mind test. Look, it does not matter if your company is registered in Panama, the BVI, or on Mars. The CRA asks one question: where does the central management and control of this company live? Where are the big strategic decisions actually being made? If the heart and mind of your business is at your kitchen table in Toronto, then as far as the CRA is concerned, your business is Canadian and can be taxed as such. Now, beyond where the decisions are made, there's also that permanent establishment test we touched on. The obvious examples are a physical office or a warehouse. But in our digital world, it gets much trickier. And this is what catches so many online businesses by surprise. Even if you have no office and no employees in Canada, the simple fact that the physical web servers that host your website are located here could be enough for the CRA to say you have a permanent establishment, making your global e-commerce business taxable in Canada. Okay, let's pull the camera way back for a moment and look at the big picture, because the entire world of international tax is going through a massive revolution. All the old rules, the old strategies, they're disappearing fast. Just look at this timeline. It tells you everything you need to know. The past was all about bank secrecy and tax havens. That world is dead. Today, right now, we live in an era where over 100 countries have agreed to automatically exchange financial information. Your bank in France is telling the Canadian government what's in your account. In the future, with central bank digital currencies on the horizon, we are heading towards a world where every single transaction could be traceable. The era of zero tax and hiding money is slamming shut. Now, this new digital reality creates massive headaches for governments. Just look at Canada's attempt to tax foreign streaming services like Netflix. The government brought in a new rule that said individuals, you and me, were now supposed to self-report and pay the sales tax on our subscriptions. They wanted to tap into this huge new revenue stream, but their plan had a bit of a flaw. And here's the flaw. An auditor's report came out, and the number was just stunning. Since 2017, the grand total of payments received under this rule was 500. Not 500,000, 500, in the entire country. It shows just how impossible it is for governments to enforce these kinds of rules on millions of consumers, which is exactly why they're now shifting gears and forcing the platforms themselves to collect the tax. So, after all of that, residency, investing, business, the future, let's bring it all home. What are the key things you really, truly need to remember from all this? Let's boil it all down to 4 simple truths. First, cutting tax ties with Canada isn't about flipping a switch. It's a complicated process based on where your center of life truly is. Second, always remember the trade-off. You get Canada's amazing healthcare and social programs, but you pay for it with very high tax rates. Third, the era of hiding money is over. Assume total transparency, because that's where we are. And finally, substance always wins over form. Where you actually run your business from is so much more important than the address on the paperwork. And that brings us to the final question, the one I want you to really think about. In this new world of global cooperation and total financial transparency, is your international structure built for the future? Or is it a relic built on the rules of a past that simply doesn't exist anymore? Because the game has already changed.